Hello and welcome to Young Turks, India's longest-running show on startups and entrepreneurship. I'm Shereen Bhan. And before I start, let me wish all our viewers a very happy new year. On all accounts, I'm sure the Indian startup ecosystem is hoping that 2023 turns out to be better than 2022. Fears of a recession, onset of a funding winter, piling up of losses and the agony of layoffs. It has been a difficult year. Venture capital investments slumped to $24 billion in 2022 from a record $35 billion in 2021, which we can all agree perhaps was an aberration, and we're now starting to see a little bit of a reality check. And therefore, one might say 2022 called for a reset on all metrics. The rout of newly listed tech companies has made investors demand a path to profitability as they rethink valuations. Unicorn after unicorn has continued to report staggering losses, from Byju's and BharatPe to Swiggy and Meesho. The list is long. It's quite evident that growth at any cost is now passé. In fact, the focus on conserving cash and bettering unit economics has forced some of the most funded, most valued startups to cut jobs. Indian startups have laid off over 18,000 employees in 2022. By most estimates, 2023 is going to continue to be a tough one for the global economy, and startups will not be immune to the headwinds. So what is the playbook to survive and thrive in 2023? Joining us on the show, Mohit Bhatnagar, Managing Director at Sequoia Capital India, and Prakash, partner at Accel. Gentlemen, appreciate you joining us, and a happy new year to both of you. Mohit, let me start by asking you that much talked about black swan note that came in from Sequoia in 2020 at the onset of the pandemic, and how different the world turned out to be, especially for tech and for startups. Record-breaking numbers. As we enter 2023, what is the note that you're sending out?
Well, first off, Shereen, Happy New Year to you and all your viewers, and thanks for having me back on the show. Look, a lot has changed, and still not a whole lot. And what I mean by that is we have to remember that investing and building companies and startups is a long-term approach. And there will be bear and bull cycles during that period. The overall sentiment really for us is after 5 years of unprecedented bull markets where any company was getting funded, we had a correction last year. And a lot of our startup ecosystem is well-funded, well-capitalized, but used the last 12 months to actually get fitter, to actually get more efficient, to actually cut out some of the extravagance, the wastage, and get back to the core that actually helped them create the startup in the first place. So it may not be as visible yet because all the latest numbers have not been put out to you. But I will say this to you. The vast majorities of startups in India have used the last 12 months very efficiently to hunker down, focus on what's core to their business, focus on just customers and product, and really cut out a lot of the extravagance. So I actually think they're pretty well poised because they're well funded and capitalized from previous years, and they're actually getting ready to be entering 2023 in a much fitter way.
So I would imagine, Mohit, that you're basing this on your experience with your own portfolio companies. So would it be fair to say that that the losses, and we just gave out some numbers for the likes of BharatPe, Swiggy, Meesho. BharatPe 5,584 crores, Swiggy 3,629 crores, Meesho 3,247, Udaan 3,000 crores. You're saying that because the environment has been difficult and people have been forced to hunker down and get fitter, we are going to see a considerable reduction in losses? Is that the experience that that you have based on conversations with your own portfolio companies?
There is a longer list of companies, including these, that you will see a definite improvement. And the unit economics has been a massive focus across all boards, across all founders, across all new investors in the last 3 quarters. And there are marked improvements in terms of the unit economics in many of these companies. So look, it's a journey for these founders. There was an expansive mode. Growth was getting rewarded. Clearly right now, quality of businesses is getting rewarded. And our founders are really sharp, really nimble, and will react to that. That's my expectation.
Well, they have no choice but to react to the current economic reality. Money is tight, funding is tight, and they will have no choice but to hunker down and get fitter to be able to survive and ride through this storm. But Prashanth, let me address this issue with you as well. As we heard there from Mohit, that he believes that some of these companies will perhaps emerge stronger through this down cycle. He also said that 2022 was a year of a correction. And to be fair, it's not just 5 years. We've actually seen a 10-year bull cycle for most parts of the world, the US included, and that really has found its way in terms of liquidity into large markets like ours. Do you foresee a long bear cycle? Are we in the midst of a long bear cycle? And what will be the casualties of this controlled growth environment that we now seem to have entered?
Shereen, thank you for having me on Young Turks again. I would say that there is another, dimension here, the whole IPO markets, right? And I think a lot of the reality check, while it came from investors, I think some of it also came from the ultimately the markets have to be where investors and these companies have to find profitable exits. And I think what was being rewarded there was very different. So I think the silver lining here is that if these companies are able to correct, like Mohit is saying, and I think a lot of them are on track to make these corrections and change their trajectories from growth and different types of metrics that were being rewarded to now what really the markets value. I think you will see that while there is a bear market overall in terms of funding, but they could still be great companies that find value in the markets and could IPO. And that could also create a better virtuous cycle and some positive momentum in the ecosystem. So that's the other thread that could really shape up this year, provided some of these companies are able to tap the markets and do that by being more profitable. And it's okay if they're growing 30-40%, but they need to have a more sustainable track record for profitability. I think that's what would kind of change the narrative in the later part of this year.
You know, Prashanth, talking about changing the narrative, and you believe that the IPO market could perhaps provide that pivot in terms of a narrative change and a narrative shift. 2022, by the way, has seen significant confidence erosion, primarily on the back of what's happened as far as these new listings are concerned. Prashanth and Mohit, let me address this with you. You know, for instance, the last 48 hours headlines as far as Mama Earth is concerned, what the expectation is on valuations, the company and the founders coming out and presenting their point of view and so on and so forth. Has the startup ecosystem understood, has that memo now really been understood about the divergence and the disconnect that we saw play through in terms of valuations with public and private markets? And have the lessons and the course correction been internalized? Prashanth, I'll start with you.
Yeah, I would say that it has been understood. These are two separate things, Shereen. One is the fact that you got to be profitable and that growth at any cost is not going to be rewarded by the market, I think is well understood. And I think there's enough corrections. Now, when it comes to discovery of what the right valuations are, I think, it's on company by company, based on the sector it is in and how the markets value certain brands. But there have been a good track record of other consumer companies, Shereen, 2 to 3 D2C companies that have gone public in the last year that are trading well above their IPO numbers. I don't talk about any specific ones, but there are a good host of them. So I think there is a good template, and the smart companies will apply that template and see what, they need to leave some money on the table for the retail investor. That's the bottom line. And SEBI and the other regulators are also now going to push companies to kind of adjust to this. So I would say all in all, there'll be an overall more readjusted environment for both valuations and for how companies would kind of go in terms of their IPOs.
Mohit, I want you to pick up on that as well. And, overall, in terms of readjustment, to pick up on what we just heard there from Prashanth, are we done with the valuation readjustment to a large extent, or do you believe that there's likely to be much more pain on that front? And two, of course, the regulatory pushback is there. SEBI has made no bones about the fact that they're watching the startup DRHPs very, very closely, asking back for further information, making sure the disclosures are out there much more effectively put out in the public domain. But on the IPO front, what's the expectation for 2023?
Actually, Shereen, I want to make 2 points. First is I think we should celebrate a big change that has happened in the last few years. Please understand, 3 years back, it was very unlikely for us to actually see a tech startup in India list in India. And then suddenly we had 2021, where he had a slew of companies, of founders, who had made an important decision, which is that rather than sell their business to somebody else and be part of somebody else's house and consolidate, they wanted to build long-term, enduring, independent businesses. And going public was one way to do that. And when a founder makes a decision like that, it's a huge decision, because now it is about being able and being answerable to many retail investors, to many other folks, to actually have not a year-long AOP, but almost have a decade or two vision that they have to put out for folks to buy into their story. So I want to point out the fact that a lot of the startups that you're pointing out that have lost value are actually the forerunners and the pioneers for many other startup founders to learn as to how do you do this? How do you actually go public? How do you do a good public offering? How do you actually guide the street well? How do you actually make your business more predictable with better unit economics, so that you can actually answer the street's call for profitability? But it's a positive thing, not a negative thing, that Indian tech startups are choosing to go public in India. So that's point number one. Second point is, please understand what's happened last year has happened globally. Some of the world's best companies, tech companies, are down 60, 70%. So I don't know if we should be double clicking on these numbers and valuations as much as we are. These numbers could be vastly different a few months out, right? So for me, the bigger message here is having a long-term sustainable exit pipeline of Indian tech companies that understand profitable, sustainable businesses will succeed on Indian IPO markets, and us to make sure that we have a pipeline of those coming for the next decade. That's the important point.
Oh, absolutely. I completely agree with you. And, I want to reinforce the point that you made at the start, that an IPO is not merely a financing event. It's much more than that. And I think, that is what both Prashanth and you are highlighting. But, this is the current reality. And to your point, Mohit, when you said that you believe a vast majority of, for instance, your portfolio companies will emerge stronger through this, where do you believe the vulnerabilities lie? Which are the pockets that will perhaps find it hard to make the pivot on the back of the existing business models? Because, it's going to be tougher if you're not, especially if you're not well capitalized and you don't have a long runway, tougher to get access to finance. And if you continue to burn as much as you are burning today, it's going to be hard to survive. Which pockets do you believe are going to find themselves most vulnerable?
So broadly, we've seen two types of businesses: those that are selling to, say, the developed markets like the US, or maybe to to Europe with the issues it's been having in the war. So think software businesses. We've certainly seen a softening of demand for companies that are in the exports or SaaS businesses. Frankly, a lot of businesses that have been going after the Indian opportunity in 2022 have actually hit plan, have actually hit their numbers. So far, we've seen that distinction between our companies. But I think the bigger point you're bringing out is the correct one, is if you were getting rewarded with multiple rounds of financing with vanity metrics like GMV and users, and that did not translate in a predictable manner into some level of monetization, then you're in trouble. And that just meant that you did not have real product market fit for actually having consumers willing to pay for your product or service. And those are the companies that I think would be the hardest hit.
Yeah, Prashanth, I want you to come in on that as well. And, while we do talk about the pain, the pressure and the vulnerabilities, let's also talk about what's looking good at this point in time, what continues to look exciting and inspire confidence.
And here, Shereen, I think we don't talk so much about the B2B industry and the B2B sector within India. Like Mohit said, there is the build in India for the rest of the world. We can speak about that later. But the digitization of the Indian B2B sector, I think is a massive story. And if you really have to realize the value of the China plus one strategy, or the aggregating of the supply capabilities within this country, that can only happen through the type of digitization that some of these startups are enabling. And these companies don't burn a lot of money. So they are profitable pretty much year one or year two. And now the ability of these companies to also use kind of an aggregation strategy across the ASEAN. See, because if you have to replace the China plus one strategy in a sense, it's just not going to happen from India. It's a combination of India plus Vietnam plus Indonesia and so on. And I think Indian B2B entrepreneurs are very well positioned to digitize this region, so to speak, and provide a SaaS-like supply capability for the rest of the world and mostly the global north. So I think a lot of these companies are scaling very well and doing so profitably. And finally, the other sector that we are seeing very good traction is in the climate tech space, both in terms of vertical SaaS platforms, because there is a lot of regulatory push and investments that are required for carbon monitoring and carbon management. And a lot of that, I think, is going to come from this part of the world.
Mohit, what's looking good to you?
Well, first, I would say we should all just be really happy that we're at the right place at the right time. I mean, honestly, if we look back, 10 years from now, we will realize that this 2023 may have just been the best time to start a company. And I say that for two reasons. First is, you talked about the number of funds that have raised capital. Sequoia raised $2 billion last year for the India market. Accel raised 650. Similarly, Lightspeed, Elevation. Just in these four funds, $4 billion was raised for investing in seed and early stage companies, on growth companies in India. And the one thing I would make sure that the founders listening to the show understand is there is plenty of capital for quality businesses in 2023 and onward. So capital is available, easily available. The second is the Indian consumer is clearly used to and adapting digital services very quickly. 800 million smartphones we've heard of, over close to 8, I think, billion transactions on UPI in December alone. I mean, how many markets have a digital savvy consumer who has got under penetration of many products and services, and you have an available set of capital? Now the market presents you a macro where talent is a lot more affordable to a founder. There are lesser distractions for the founder. I just think 2023 is a perfect time for many smart founders to get down there and build new companies. So I'm very bullish on what we're entering as a phase of new company creation.
Clearly a very bullish Mohit Bhatnagar there. Mohit, you said capital is not an issue. There's plenty of capital available there. 4 billion between Prashanth, you, Elevation, Lightspeed. Are you deploying capital at this point in time? Are you holding back? I understand there's plenty of dry powder, but are you putting the money to use just yet?
Absolutely.
Or is it still wait and watch?
No. Every day, we have founders, meeting a number of investors all across the country. The doors and the shops are open. Everyone needs to know this. Companies are getting created as we speak, and companies are getting funded as we speak.
Shereen, I think
Mohit Bhatnagar's door is open. That's the message loud and clear here on Young Turks. So if you're a founder and you're listening, that should be music to your ears. Prashanth, you wanted to come in on that as well.
Yeah, no, I was just saying, Shereen, I think the bar definitely is very different in this environment. And I think founders who are product focused and who can build customer value is something that I think will have a very different traction this year. And I think it's a lot of money out there, but I think for the right kind of founders.
Well, yes, that's the graphic on your screens. VC's coffers run full, as Mohit and Prashanth have both just articulated here for us. And that certainly is good news. But Mohit, I want to get both of you to comment on the big event that's coming up in February, and that is the union budget. Now, in Budget 2022, the finance minister had promised to set up a committee to take care of the regulatory friction that private equity investors and venture capital investors face in India. The Damodran committee, we understand, has submitted its report to the government. There are several recommendations that have been made there. For instance, carried interest should not be treated as something that carries GST with it. It should be treated as capital gains. And of course, many other recommendations we understand have been made. What's the expectation, Mohit?
Well, I'll just say this, it's seldom do we find a country where government and industry works as closely as we are seeing. I'll give you the most recent example is the gaming regulations that came out. Clearly an example of where industry is consulted, a lot of startup ecosystem, voices are heard, and something balanced and something sustainable comes out. So I would say, without getting into the specifics, is we're really happy with the level of engagement. And I think for the most part, the startup ecosystem feels heard as we're getting into these discussions, whether it's around taxation, whether it's on regulations in the different sectors that we invest in. We've really been very, happy to see the constructive approach.
Well, yes, that certainly has been the case. And we just saw the government put out the draft as far as online gaming is concerned, up for public consultation. Prashanth, a large part of the sort of regulatory uncertainty, whether it was edtech or online gaming, do you believe that we are at the end of that and more clarity has emerged or is emerging?
Definitely, I think there is a lot of clarity on those regulations, but there are still a few areas, I think, which, like you said, the Damodran Committee has to find solutions for. One is the definition of what is a startup. So there is an inter-ministerial board that is being set up, where a lot of these nagging issues like ESOP, the taxation on ESOP, they all look like they can get solved if we know we can solve, if we can solve the startup definition issue. So that's one broad. The second big issue, I think, is there have been these large fund of funds that have been set up and enabled across agri-tech, clean tech, pharma, deep tech, and so on. So I think we would like to see also some of these funds, fund of funds, also bring in more domestic capital and increase the momentum in some of these emerging areas. So there are a few of these areas that where we could see a little bit more action this year.
Well, yes, let's see what the government decides to do with the recommendations put forward by the Damodran Committee. Will they find their way into Budget 2023? We don't know, but that's the expectation. Gentlemen, I want to end by talking to the two of you about something that I know you're both passionate about, and that is how the startup ecosystem can actually give back. Of course, they need to give back in terms of profitability and showing the money to start with, but outside of that as well, as citizens of this country, in terms of what you are doing through the ACT grants. Mohit, let me start by asking you, what's the priority going to be for 2023?
Well, I think the main priority is just to remind everyone that we all have a ability to give back to the communities that nurture us and help us create these startups and these successful businesses. In fact, I wouldn't even say it's an opportunity. It's actually a responsibility to do the right thing and give back to those that do not have the same opportunities that all of us have been given. And it's in that context that the startup ecosystem, investors, founders, the larger ecosystem came together to create this thing called ACT Grants, which is a collective giving back platform for basically doing what we do in a commercial sense, which is make investments, but in this case, give grants, not for equity, but just pure grants to founders and startups that want to make social change in education, in healthcare, in environment, in gender issues. So these are 3 or 4 areas that the startup groups have come together and said, we want to make some real serious, significant change, and we're willing to put money in terms of grant money and then help nurture and scale these different nonprofit and for-profit social sector startups. So we're very excited about that. It's an early start, but and we're really hoping that more founders and more investors step up and lend their shoulder to this effort.
Prashanth?
Yeah, I think the other important thing that we've been able to achieve is really bring in a lot of the learnings from the startup ecosystem to the social sector. And I think that is where we see a lot of value to bring in a new momentum and energy to the social sector with the same kind of urgency and ability to build scale in our ability to solve. Shereen, we have 75 years right into our thing as a nation. The belief is that what startups could do and have demonstrated in the last decade in a broad set of sectors, can we take some of that to the larger populations in this and demographics in India, which have not been impacted or we have problems that can be solved in the next 25 years and we don't need another 50 or 75 years. And we think that is possible because of what the startups have demonstrated in a very different space. And can we apply that now here?
Absolutely, to try and bridge some of those crucial access deficits that we continue to face. But gentlemen, I want to end by asking you, Mohit, I'll start with you. You said that you believe 2023 is going to be a fiscally fitter startup ecosystem. But, what is the runway now to profitability? Are we talking about the next 3 years, 5 years, 7 years? What's the average that you're working with as far as your portfolio companies is concerned?
Well, the headline for you to know is at every company board meeting, at every investor interaction with the founders, unit economics is core and center to the discussion. People have understood that in order for you to make progress, it's not about just profits. It's about being able to show a sustainable business model. And that's the only way you will get your next round of capital to help you scale, to move into newer adjacencies, newer markets, and so on and so forth. So the days and the years might vary. Typically, a startup has at least 2 years of runway at the very least. That's how folks work backwards from. Many others have been fortunate to get even longer runways. But it's less about the amount of time you have, Shereen. It's more around how do you really demonstrate a predictable, scalable way to monetize your traffic, your consumers, your users.
Prashanth, the same question to you. What's the average that you're looking at across your portfolio companies in terms of the path to profitability? And to the lay public, when they look at this story at this point in time, and to a large extent, of course, there's been a lot of euphoria, rightly so, because we've seen first-generation entrepreneurs create businesses in this country over the past decade or so. But there has been a little bit of a confidence reset as well. What is it that you would say to people who are looking at startups and saying, oh, it's all easy VC money that they have access to, and, they're able to run these businesses, essentially loss-making businesses? I mean, what's the viability of some of these businesses? That narrative has also gained a fair degree of traction through 2022. How would you address that?
So, Shereen, to answer the first question, if you can become profitable, you have an infinite runway. So there is no reason to raise money anymore unless you really want to accelerate growth. So that is the best situation a lot of these companies can get into. And I think all of us in our boardrooms are pushing companies to have less of a dependence. We don't know the environment to be able to raise a lot more growth capital. Could be 12 months, 24 months. None of us know. I think the more these companies can be self-sustaining and independent, I think the runway also can be infinite. That is the first answer. On the second part, I think you will be surprised how nimble, while startups are smart when it comes to taking advantage of a situation where there is a lot of surplus money. I think startups are also smart in readjusting to this new environment where there is a scarcity of money. So you will, I think, be positively surprised, and you will see a lot of startups that will actually demonstrate actual EBITDA profitability in these 12 months. And that will change the narrative. And we'll have a lot of people who believe that startups are just about cash burn and startups don't have sustainable models. A lot of them will, and not all of them will, but I think if you have a good set of them do that this year, I think that can fundamentally change the narrative. And a lot of them might not go IPO this year, but when you see the same numbers in the next 12 months, you will see a more sustainable a set of numbers.
Well, that is what we're hoping for, that we will emerge through this difficult period with more sustainable startups, with more sustainable companies. At the end of the day, as both Mohit and Prashanth have pointed out, you cannot control the external environment. You don't know what's going to happen as far as interest rates is concerned and the cost of money. What you can control is your own unit economics. So that is what you need to focus on and emerge stronger through this difficult time. Mohit and Prashanth, always a pleasure. Appreciate you joining us here on the first edition of Young Turks for 2023. We look forward to having you back, and we hope that we will see the startup ecosystem emerge stronger through this period. Appreciate your time. We will take a break. There's a lot more coming up. Don't go anywhere. We're back in a minute with more.